The big picture read on the markets is somewhat of a mixed bag, as we'll cover in this week's video, but we do have enough deterioration in place to view any rally attempt with a skeptical eye. In this week's video, we'll use the expressions glass half full and glass half empty from a half full perspective, as we covered a few weeks ago. When the market peaked recently, didn't really have a big picture profile of a major top, which tells us the lack of divergences at the recent peak and lack of yellow flags. We may need another push higher even under the most bearish scenarios. It's possible that we're making some type of topping pattern, maybe a head and shoulders type pattern. If that's the case, that again points to another rally attempt in the coming weeks. However, evidence of improvement must surface, and the big picture as it stands now continues to weaken, and it's concerning. So we need evidence of some type of turn or evidence that aligns with a possible topping pattern scenario. We don't have that as of the close on Friday, August 30th, but we're open to seeing it in the next few days and weeks. If we look at the slopes of the 50-day moving averages on the S&P 500, Dow, and NASDAQ, we'll see that that's somewhat of a mixed bag. Last week, the S&P 500's 50-day moving average actually rolled over, and then it went flat, and then on Friday it was positive again. And some of our rules tell us that there are just certain things we can't do from a bearish perspective when the slope of the S&P 500's 50-day is positive. It's not convincingly positive, but on Friday it closed in a positive manner. The Dow's 50-day is indecisive and flat. All of this tells us that the intermediate term trend is indecisive and could still go either way. As we'll show later in this video, the NASDAQ's 50-day is still convincingly positive. So mixed bag here, tends to err on the bearish side here if you look at the big picture, and this one tends to err on the bullish side. In the remainder of the video, we'll look at the VIX, the S&P 500 from a weekly trend perspective. What can we learn looking at long versus short, stocks versus bonds, credit spreads, the slope of the Dow's 22-week moving average from a historical perspective, and we'll review the current readings on the CCM market model. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Had a meeting in Seattle Saturday, very enjoyable trip. Some of this week's video is recorded from the hotel room. Therefore, cursor movements and portions of the audio may have been impacted from a quality control perspective. This is the master spreadsheet for the CCM market model. Recommended risk exposure for our clients and for our risk tolerance. Yours may vary. 45% on the risk exposure side as of Friday's close on August 30th, and roughly the same at 55% on the conservative end of the spectrum. Having built these models and understanding what they are and what they are not, when you get scores that are near 50-50, it's important to keep an open mind. The market has deteriorated, but not to a point where the bears are fully in control yet. And again, can't emphasize enough, it's important to keep an open mind about where we go next. The next move could be relatively sharp in either direction. We're still allocated in such a way, and we are allocated roughly at 55-45 as the model calls for. We're still allocated in such a way that we could migrate either way depending upon what happens next. We could easily go to 60-40 or back to 60-40 in this direction. This week's video will show a lot of glass half empty developments and charts. It's important to keep in mind, given that near 50-50 split in the models, something still must look bullish and or healthy. Here's one example. This is a daily chart of the NASDAQ Composite Index that's used in the CCM market risk model, which is a submodel of the CCM master market model. 50-day moving average, NASDAQ Composite Daily. Slope is positive. The blue line tells us that the intermediate term trend for the NASDAQ is still clearly positive. The 200-day moving average in red tells us that the long-term trend is clearly positive. If we are to go into a significant correction and or a bear market, mathematically something has to change here, and the way it typically would work is the 50-day would eventually flatten out and then roll over under bearish conditions. If we were to migrate to a full-bore bear market, the same thing would eventually happen with the 200-day moving average. It would flatten out and roll over, and eventually price would go below the 50 and the 200. Moral of the story, this still looks healthy, and something has to happen from a bearish perspective to change that. Concerns would be that momentum here for the daily NASDAQ currently looks similar to this period here where weakness followed. Now we're looking at a weekly chart of the Dow Jones Industrial Average. This is another chart used in the submodel, which is the CCM market risk model. Two things are used in the model primarily. You look at the 22-week moving average here in blue. The questions you ask, is price above or below the 22-week moving average? You can see here when price dropped below the 22-week, additional weakness in the Dow followed. When price dropped below the 22-week here, weakness followed. We're below the 22-week on a closing basis, and you'll notice that's the first time that that's happened in 2013. That's the glass half empty side of the story. What has not occurred yet is the 22-week, the slope has not rolled over. So if we are really going to morph into something significantly bearish like a bear market, we would expect to see the 22-week rollover, and that has not happened yet. We do also have weak momentum on this chart from a glass half empty perspective. Before we shift gears and go into the CCM Big Four, this is another chart used in the CCM market risk model, one of the submodels. This is risk on, risk off. This is the S&P 500 relative to the VIX Fear Index, and this is a monthly chart. Makes sense to look at a monthly chart because we just finished out a month, and the way that this chart looks now is etched in stone and won't change intra-month. The model uses the slope of the 12-month exponential moving average for the ratio of the S&P 500 relative to the VIX. This is the ratio here, this is the ratio here, and this is the EMA 12 on a monthly basis. You can see here when the slope rolled over, weakness in the stock market followed. When the slope of the blue line turned over on a monthly closing basis, weakness in the stock market followed. Rolled over on a monthly closing basis, stock market fell further. For the first time in quite a while, going all the way back early June 2012, the slope of this line has now turned over on a closing basis. What does that mean? It just increases the probability of further downside in the next 30 days. It doesn't rule out a bounce in the short term or a rally for 2 to 3 weeks. This is risk on S&P 500 relative to risk off, or the SH ETF. When the ratio is rising, this is what risk on looks like. This is what risk off looks like. Price below the moving averages, we have a bearish moving average crossover with blue below red. The bullish look is a mirror image of that. Price above, blue above red, the slopes up. Point of the exercise, when we get a bearish moving average crossover on this ratio, the stock market down here tends to be weak. Bearish moving average crossover here, stock market is weak. Bearish moving average crossover here, stock market is weak. You can see in the present day, we have a bearish moving average crossover as of the close on Friday, August 30th. Point D in this graph looks similar to point A, point B, and point C, where weakness in the stock market followed. The bearish moving average crossover doesn't necessarily predict anything. It just tells us that the odds are against us from a weekly trend perspective in terms of being long relative to being short. It doesn't tell us how long this ratio will continue to fall. It could be a longer term correction like the one that occurred in the fall of 2012 or the one that occurred in the spring of 2012. Or it could be relatively short, similar to the one that we had early in 2013. Purpose of the exercise, we respect the bearish look as long as it remains in place. If we get a look like this, then we will respect the bullish look. Thinking ahead here a little bit, it's possible that we could be seeing some type of topping pattern where this could be a left shoulder, this could be a head. If we came down into this area here and bounced up, that's one possible scenario. We don't account for that in advance. We don't allocate for that in advance. It's just something to think about from a probabilistic perspective. On this chart, momentum-wise, momentum when it drops out of overbought below negative 20, here where the cursor is, the stock market tends to be weak. Drops out of overbought, weakness in the stock market follows. Drops out of overbought, weakness. Not only have we dropped out of overbought, but we've also crossed below this dotted blue line here. Weakness followed below the dotted blue line, and momentum weakness followed above, weakness followed above. So until this look improves and looks something more like this, we will respect it as bearish weakness. This is chart 1 of 4 of the CCM Big Four. Now we're looking at the S&P 500 weekly in isolation. All the concepts that we presented on the previous chart apply. Bearish moving average crossover, weakness in the stock market followed. Bearish moving average crossover, weakness in the stock market followed. Bullish moving average crossover, the stock market did well. Bearish moving average crossover. We have a bearish moving average crossover in place on this chart, as we did with the ratio of the S&P 500 relative to shorting. The purpose of using the moving averages is to help us distinguish between volatility that should be ignored within the context of a rising uptrend and volatility that should be respected. Bullish cross, ignore the volatility. Ignore the volatility. There's no bearish cross here. Bearish cross, respect. Bearish cross, respect. As we mentioned in the last chart, the bearish moving average crossover does not predict how long we will fall. As long as it remains in place, we will respect it, and we'll head into next week with an open mind. This is chart 3 of 4 of the CCM Big Four charts. Now we're looking at risk on the S&P 500 relative to risk off the aggregate bond market. This chart helps us answer the question, would I rather be in stocks or would I rather be in bonds? The same concepts apply. You can see when the ratio gets a bearish moving average crossover here, weakness in the stock market followed. Bearish moving average crossover on the risk on, risk off ratio, weakness in stocks follows. In 2013, you'll notice this chart here earlier in the year came close to rolling over on 2 occasions, really 3, and it never rolled over, and we never had a bearish moving average crossover on a weekly closing basis. We did get some crossovers or head fakes intra-week, and that's why it's important to look at these charts from a weekly perspective. Intra-week, you take anything with a grain of salt, or you move incrementally intra-week, understanding that the chart could repair itself before the close on Friday. So what we currently have is a risk-off look to this chart, and you'll notice it's the first time that we have a bearish moving average crossover on this risk-on, risk-off ratio in 2013. We also have an upward sloping trend channel in green that has been broken, and this dotted upward sloping bullish trend line has also been broken. So like the other charts, this chart doesn't predict how long the ratio will fall or how far the stock market will fall. But it does tell us that as long as it has this bearish look, as long as this looks similar to this and this, we respect it. If this can morph back into something that looks like this or this, then we'll be more open to upside in risk assets. Before we go to chart 4 of the CCM Big Four, let's just revisit the model that those charts are used in, the CCM correlation model, which is a sub-model for the CCM market model. These are the charts and ratios that are used in the model. As we've mentioned in the past, the higher you are on this list, the higher the correlation to the S&P 500. The lower you are, the lower the correlation. Therefore, higher predictive validity from a probabilistic perspective relative to the direction of the S&P 500, lower predictive validity in terms of correlations relative to the S&P 500. And you'll notice before we go to JNK TLT, it carries a much, much lower weight than the standard aggregate bond chart versus the S&P 500, long versus short, and the S&P 500 in isolation. Why do we use it? It is helpful. It's just not as helpful as these charts that appear above it in this list. This is the weekly JNK, or junk bonds relative to more conservative treasuries. This is risk on relative to risk off. When the ratio is rising, more aggressive junk bonds are in greater demand than more conservative treasuries. The inverse is true here. Treasuries are in greater demand relative to higher yielding junk bonds. Here, when the ratio experiences a bearish moving average crossover, it's helpful and the stock market falls. Here, it's helpful in terms of momentum slowing here as the stock market's falling. You get the bearish moving average cross and the stock market does continue to fall here on a weekly chart. Why it carries a lower correlation in the model, here's an example. Bearish moving average crossover in 2013. Currently, this chart has not experienced a bearish moving average crossover. Blue is above red. However, price is below both moving averages, and you'll notice that's the first time that's happened on a closing basis during this whole rally in the ratio. So something has happened here that hasn't happened during this move here in the ratio. You also have the slope of the blue moving average and the red moving average turning down. It's also noteworthy that momentum for the ratio, so this is Williams percent R, momentum measured off of the ratio, has moved out of overbought territory. And you can see when that happens, weakness in the stock market can follow. Out of overbought, weakness in the S&P 500. Out of overbought, S&P 500 is not weak. Again, why the model carries A lower weight for this chart is relative to long-term historical correlations. If this chart rolls over and becomes similar to the 3 previous charts we looked at, it would increase the odds of bearish downside risk in the S&P 500 index. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.